As the title slide says, I think 2018 is all about late innings. And when I talk about late innings, I'm talking about late cycle, late economic cycle, that is. Most economic cycles have a fairly well-defined pattern to the way different markets behave as you move through the economic cycle from peak to trough to peak. And I'm not saying that I think we're going off a cliff in 3 months or anything like that, but we're definitely, finally, I think after 8-9 years, we're entering the sort of the terminal stage, which may well last for 2 or 3 years, but things will behave somewhat differently during that part of the cycle, and they behave differently in a way that's advantageous for us as it happens. So I'm kind of glad we're finally getting there. Essentially, what you've seen in the last little while is increasing signs that we're getting to that late part of the cycle. You're seeing sort of classic late cycle movements. The strength that you're seeing in base metals, for instance, that's fairly common in late cycles. Strength in anything you could sort of define as an inflation hedge, or I suppose a speculative asset. And at this stage, I'm not even thinking. The obvious things that probably occur to everybody right now is cryptocurrencies, but I'm also thinking in terms of things like art, collectibles, real estate. You've seen most of those things ramp up in terms of how fast they're moving higher. This has been a very unusual cycle because of the depth of the previous dip and because of all the central bank intervention. It's really changed the money flows through this entire cycle, which has made it a pretty strange one in a lot of ways. And I'm just gonna quickly step through. This is basically normal late cycle characteristics that you'd expect, classic economic stuff. As you move through the cycle, unemployment rate drops and drops. Eventually you get to the point where you start seeing excess demand for workers and you start seeing wage increases, and that's normally where you see inflation really start to move. It's essentially demand push inflation. That's usually where it goes. At the same time, at a company level, at an industry sector level, there's enough growth through the cycle that you start getting capacity constraints. Your capacity utilization for plants, utilities, factories gets to the point where they also start having pricing pressure and also supply pressure, where they just can't move, they can't increase supply as fast as they could earlier in the cycle. The same sort of thing happens at the financial level, where instead of getting capacity utilization constraints, you basically start seeing increasing leverage. And we've seen that pretty much across the board in just about everything except maybe our sector in the last 2 or 3 years. The classic late cycle on the equity side is something that we've actually been seeing for the last month or so in the major markets, and I'm hoping it's just an early stage one, and that's essentially a classic melt up. Mom and pop realize there's an equity bull market going on, and they decide to jump in with both feet. A lot of them, as it happens, you're jumping into cryptocurrencies right now instead of straight up equities, but you see a lot of the money flows into ETFs, things like that. If you look for the last 2 or 3 years, you would find most of the flows into large-scale funds did not actually go into equity funds, they went into bond funds. I think you will see that reverse this year, because the other thing that happens at this part of the financial cycle is you generally start seeing interest rates start to move, which we've seen. And before I'm going to walk through basically half a dozen commodities and what I think is going to happen this year, but just before I start that, I just want to reiterate that this cycle has been a really weird one, a really different one. Commodities, for instance, we had extreme strength in the commodity cycle. It was a super cycle, 2001 to 2008, and because of that, we did actually get a fair amount of supply increase across the space in different metals and materials. In some cases, those big capacity increases didn't actually show up until after the Great Recession in 2009, if you will. That's why we saw commodities come back very quickly, largely thanks to buying out of China after 2009, and then they fell off in about 2012 when capacity increases caught up with them. But a lot of that's getting worked through now. Most of the metal sectors, not all of them, but most of them, you don't have big supply overhangs anymore, and we are getting to the point where you're going to see that lift. And the other thing that it's been a little strange this time, especially given how low interest rates are and how much money is being pumped into the system by central banks. One of the odd things about this cycle is private loan demand hasn't really grown that much. That may again be something we see actually move up this year. It's been one of those real puzzlers for guys like me that look at things like growth in lending statistics and you just aren't seeing it, and it's weird. It's actually strange, but I think part of that may be the fact that with equity valuations so high, there's no crowding out because a lot of the big companies, they don't have any trouble selling debt, but they also have no trouble selling equity. So I think some money shifted over to that. And again, I think you're going to see that go the other way starting probably about now. But after 8 years, we have finally seen unemployment get to the rate, not just in the US, but also in Europe. I mean, obviously there's some problem areas, but there's several of the largest economies in Europe, their unemployment rates are very low. Canada's is very low. Japan's, you can barely see it, it's so low. We should finally be getting to the point now, I hope, where we start seeing broader wage increases, because really, until now, the other odd thing about this cycle was, as big as the gains were in terms of GDP gains, they were very much concentrated in a very small percentage of the population. And that's particularly true, I think, in the US, where the lion's share of the gains from this cycle went to a very small number of people, which, as nice as it is, if you're lucky enough to be one of those people, I don't think that's a good thing or a healthy thing in the long run. So, I mean, I've been pounding the table for a couple of years that I'm hoping to see this broaden out, and I'm hoping labor markets are finally tight enough for that to happen. Just to give you an example, here's a long-term chart. I've only got one chart for commodities altogether. I'm going to go through a couple of individual ones, but this is a chart from FRED, which is the St. Louis Fed's statistics service. It's a chart that goes back to 1970, and this is basically producer price index for all commodities. There is a bit of weighting. There's a bit of extra weighting on this one because of oil, but it's a fairly good one because it's not too specific. It covers softs, agricultural, pretty much everything. If you take a look at those circles, you'll notice that where you see the steepest moves in the overall commodity index is actually at the end of the cycle. Those gray bars that you see are recessions through that period, and you'll see, like if you go back to this one here, this of course was the super cycle. You see how large the move was in the last 2 years. Even before 2000, you had a fairly steep move. We're starting to see a move up again. A lot of this dip that you're seeing there, that's because of oil, and actually agricultural commodities are pretty weak the last couple of years too. But that stuff is all turning, and my expectation is we're going to see another one of these over the next couple of years, which should make all of us fairly happy because it's going to drive some money back into our sector. So how do I think different metals are going to do this year? This is my basic take on some of the major ones. I thought zinc was going to be the best performer last year. It was. I think it's going to be the best performer again this year. Copper, small surplus, but it is quite small in relation to the entire market. It won't take too much to get rid of that surplus. And, you know, sentiment has definitely gotten fairly bullish for copper, and you may see enough trading basically on the paper markets, on the commodity markets to hold the price up, even if we do end up with a small surplus. Lead's a pretty small market that nobody really cares about that much, but I put it in there because it's actually important to the valuations of, two zinc companies that happen to be sitting at the table here, but also silver companies. I mean, lead, there's very few primary lead producers. There's a few. Most of it's secondary. And much higher lead prices do have a strong positive impact on silver mines, on lead zinc operations. So I threw it in there. It's another one because nobody really explores for it. It only shows up if these other mines get open and pull it in as a secondary product. It's one that could actually surprise too. Nickel's getting attention because of the whole battery metal thing. I don't have anything against it, but I'm still fairly skeptical that we're going to see a large price move in the near term. Inventories are still quite high. There's still a lot of oxide production coming out of Indonesia or the Philippines. It kind of goes back and forth because both of those governments have had their own running moratoriums and things like that, but the supply has never really fallen off, and we really didn't see much. Unlike most other base metals, there wasn't much drawdown this year. Uranium, I'm not a uranium bull. Again, I'd like to see a uranium bull market. It's great for the sector. I just don't think it's going to happen for a couple of years. And then, of course, that brings us to gold and silver. One thing that I've been pointing out a lot to readers recently is, don't forget, I mean, everybody tends to get into this doom and gloom like, oh, gold's going to do great because we're all going to go off a cliff and the world's going to come to an end and we're all going to be in our bunkers with our gold bars. Gold, much like the chart I just flipped past, gold almost always does best late cycle because it's an inflation hedge, because it's a speculative asset. Money tends to flow into it late in the cycle. So we're entering the right part of the cycle for gold. Silver really has nearly as good even a start to its bull market as gold did. I'm hoping that gets better. I think most of the above ground has worked off by now, but we need to see a real shift in investment and jewelry demand for silver to start matching gold's gains. But if gold moves as high as I think it might, I think it's going to pull silver with it. I'm going to do a very quick walkthrough on each one of these ones. I mean, I just gave you most of it, but copper, small supply. There are a couple of things coming in this year, Cobre Panama, 2 or 3 others. There's a couple of expansions. Warehouse inventories right now aren't super low, but they are at the low end of a broad range that they've been in for about 3 years now. The surplus that, like the International Copper Study Group, they're talking 70,000, 80,000 tons, which is really nothing in relation to the market. One thing that is coming this year is there are a very large number of labor contracts coming up, particularly in South America, particularly in Chile. Most of the large copper producers have got labor negotiations. Because copper is trading where it is, I don't expect those negotiations to be very easy. I mean, a lot of those unions did give up concessions 2 years ago, 3 years ago, and I think the negotiations will be a lot tougher. So it's quite conceivable we're going to see enough strikes to wipe out the surplus and bring us into a deficit this year. The other thing to remember is copper, along with gold, is considered correctly, in my opinion, a good inflation hedge. Because it's one of the biggest trading markets in the commodity space, it's a hedge fund favorite. So it's one of those things that can really get ahead of steam when the sentiment's on its side, because a lot of non-sector investors jump on it. Zinc, again, favorite last year, favorite again this year. We're still in supply deficit. We will start seeing some new supply come on later this year. There's some difference of opinion about how much that's going to be. There's still analysts out there talking about supply from China, which I don't personally think is going to arrive, or at least not in amounts that are going to make a significant difference to the thesis. As I've said many times, China is very serious about pollution. I don't see a lot of those mom-and-pop operations starting up again. LME inventories now are down to about 180,000 tons. That's quite low. The bottom of the inventories in the last, zinc super cycle, if you want to call it that, in 2007, was a little bit under 100,000 tons. I think it got down to 80. The drop in inventories has kind of flattened out since the start of the year. But if we keep seeing the decrease in inventories that we saw through the second half of last year, we would be getting down to the 120 to 100,000 ton level sometime in Q2. I think if it gets down to those levels, we're going to see it really go. I mean, I think it goes through $2 sometime, probably in the first half of this year. So the timing for the guys down the table there is probably fairly good, one hopes. And the biggest potential supplier, Glencore, they're reopening Lady Loretta. That starts late next year. They're phasing it in through late this year and next year. But they've made it pretty plain they're not going to screw the market up. You're not going to see 500,000 tons of production come back on quickly. Lead, again, I'm not going to spend much time on this other than to say it basically follows zinc around, but its warehouse inventories are also getting low. And because silver prices haven't been fantastic, we're not seeing a lot of new silver mines, and that is collectively the source of a lot of lead production. We will see new supply come on stream when some of the new zinc mines start arriving in the next year or so. But I think there's actually room for it to have a surprisingly large move, because lead's one of those things that's been outlawed in so many sectors, but it is still one of the primary battery metals. It's still heavily imported into China. I don't think it's anything anyone explores for as a primary anymore, but it's there. And like I said, lead going from 80 cents to $1.30, $1.40, that makes a big difference on the spreadsheet for a lead zinc operation. Nickel, it had an okay year. It went up 20% from a pretty low base. Nickel inventories really didn't come down that much, and they're not low. By longer term measures, nickel inventories are still quite high. I know it's become a thing to talk about high-grade nickel, and by that people are saying, you know, this high-grade sulfide stuff, that's the only thing you can use for batteries, so there's going to be like these two nickel prices. There's going to be that, and then there's going to be the cheap oxide nickel. Yeah, maybe. I'm not really sold on that idea personally, that that's going to happen. Besides which, if you look at how much of the nickel market is sulfide, and you look at what the current battery requirements are, even if you assume quite strong growth, 20–30% a year, you're not going to get to the point of really pushing capacity even on the sulfide stuff for quite a while. It's going to be several years. And I don't see the market, I don't see buyers as a whole. Buyers are obviously quite happy to have oxide mom and pop operations in Indonesia and the Philippines keep the price down. So I think there would be enormous resistance to this whole two price idea. So I'm not holding my breath. See if I missed one. Yeah, okay, uranium I didn't bother putting in there. Gold, you know, if you look at the chart, it's not, you know, as much as we're all kind of, it's not a bad chart. I mean, it held the uptrend, had this very strong move at the end. This right here, that's the number that we really need to look at. I'm not a chart guy, but I know lots of really good chart analysts, TA guys, and they're all, you know, focusing on that 1360 level. And again, it's a good late cycle commodity. It tends to do well. We are starting to see, it's very early days, there's no real move yet, but we're starting to see some pricing pressure, so I'm expecting a bit of increase in inflation. That will be favorable for gold as long as the Fed doesn't try to get in front of the cycle, which I do not think it's going to do. The guy who's taking over the Fed in a couple of months has a history of being somewhat dovish. I don't think he would have gotten the job as chairman unless he'd convinced President Trump he was going to be dovish. Trump, let's remember, is a mercantilist at heart. He has no interest whatsoever in seeing a higher dollar. So, you know, not that the Fed isn't supposed to be independent, but, you know, nonetheless, there would be a lot of pressure from Washington not to try to get ahead of the interest rate cycle. And I think, obviously, that's going to help. Plus, we're just in the part of the cycle where we should see more buying. I think if we get to 1360, if we can get there and hold it, I think there's a pretty good chance we see 1400, probably 1450 actually, later this year. I mean, I'm expecting gold to have a pretty good year. Silver, as you can see at a basic level, its chart just doesn't look as pretty, but there was a lot of above ground stocks that had to be worked through, and it is an industrial metal. It's not just a precious metal, it's an industrial metal. Half the use is industrial. That's probably supported the price a little bit in the last few years, but there was a pretty big drop off in jewelry demand and investment demand in the last 2 years that really wasn't coming through at all. You know, I'm not sure what changes that at a basic level this year, other than to say if gold behaves the way I expect it to, gets through 1360, you'll see more buying in general in the precious metal space. The silver market is a lot smaller. It doesn't need the dollar volume to move it. So I would think if you see, just to use a round number, say you see a 10 or 15% increase in the gold price, then I think you probably will see, you know, a 30 or 40% increase in the silver price. Because once it starts going, there are a lot of silver bugs out there, and it does tend to get momentum. That's pretty much the end of it, but, you know, last but not least, I'm going to, you know, we'll bring up the US dollar, which is here on the left. That's the 10-year yield, US 10-year Treasury yield on the right. US dollar pretty much did what I expected. I mean, I was part of a pretty short list of people that didn't think the US dollar was going to go up last year. I thought it was going to drop, which of course it did. It's actually near a 3–4 year low right now. I'm a little bit uncomfortable about how much farther it's going to drop for the same reason I was looking at it the other way last year, and that's that it's getting to be a pretty crowded trade. Short dollar, long euro is getting to be a very crowded trade. I always get a little nervous when I see that, so we may not see it fall off that much more. Certainly, it's making Europe crazy. I'm sure Draghi's beating his head against the wall watching the euro go through 121, 122, 123. There's not a heck of a lot he can do about it, because they're also at the part of the cycle they're not going to tighten fast, but they have to do it at some point soon. So I'm not sure I see a huge amount more downside in the dollar, but we don't really need it. One thing I point out too, just to finish this off, you know, you can see how much interest rates moved since September. You know, obviously the worm has turned. The market believes the Fed is in fact going to do 3, if not 4 rate increases. Bond yields tend to take care of themselves. And the one thing that's probably going to add a little bit of pressure is with the new tax acts and stuff in the U.S., you're likely to see, you know, notwithstanding whatever fantasy numbers Washington came up with, you're going to see much larger deficits in the next few years. There's just going to be a lot more bond issuance. So we could see that move more, but it's worth pointing out that, you know, gold is not trading that much against that yet. Again, it's a classic late cycle thing where gold, base metals, interest rates all move at the same time. And that's it, folks. I'm done for now.